Hey everyone, welcome back to Crypto Tax Australia. If you've been active in the DeFi space, buying NFTs, wrapping tokens, throwing liquidity into pools, you already know this stuff gets complicated fast. And unfortunately, the more complex your on-chain activity, the more the ATO expects you to have your records straight. Today we're covering three of the most misunderstood areas of crypto tax in Australia right now: NFTs, wrapping tokens, and liquidity pools. I'm going to break down what the ATO's position is on each one, where the rules are clear, and, importantly, where they're not, because there are some genuine gray areas here that even tax professionals debate. By the end of this video, you'll know exactly where you stand, what the conservative approach looks like, and what arguments exist on the other side, so you can make an informed decision and have that conversation with your accountant from a position of knowledge. Let's get into it. Before we dive into each topic, let's quickly reset the foundation, because everything flows from this one principle. The ATO treats all cryptocurrency and digital assets as CGT assets. That means every time you dispose of one, a capital gains tax event is triggered. And dispose means more than just selling for AUD. It includes trading, swapping, gifting, and in many cases, converting one form of an asset into another. Keep that word in mind, dispose, because it's going to come up a lot in today's video. The question we're really asking for each topic is, does this activity constitute a disposal? And as you'll see, the answer isn't always straightforward. Let's start with NFTs because this is actually the most clear-cut of the three topics. The ATO's position on NFTs is unambiguous. They are CGT assets, full stop. They get the same treatment as any other crypto asset. So here's how each common NFT scenario plays out. Buying an NFT with crypto. This is two events happening at once. First, you're disposing of the crypto you used to pay. So a CGT event on whatever gain or loss you've made on that crypto since you acquired it. Second, you're acquiring a new CGT asset, the NFT, with a cost base equal to the AUD value you paid at the time. Selling an NFT for crypto or AUD straightforward disposal. Your capital gain or loss is the difference between what you received in AUD terms and your original cost base, including any gas fees paid to acquire it. Trading one NFT for another, yes, still a CGT event. You're disposing of one asset and acquiring another. The proceeds are the AUD market value of the NFT you received at the time of the trade. Minting an NFT. This is where it gets slightly more nuanced. If you mint an NFT, meaning you create it yourself, the ATO's view is that your cost base is the cost of minting, including gas fees. No CGT event at the point of minting itself. The CGT event happens when you sell or trade it later. However, if you're minting and selling NFTs regularly as a business activity, the ATO may treat your profits as ordinary income rather than capital gains. That means no 50% CGT discount. The line between investor and trader is something to discuss with your accountant if you're active in this space. One more thing on NFTs. The 12-month CGT discount applies here too. If you held an NFT for more than 12 months before selling, you may only pay tax on 50% of your gain. Given how illiquid some NFTs are, this is actually relevant for a lot of holders. Okay, wrapping tokens. This is the one that generates the most debate in Australian crypto tax circles right now. And I want to give you both sides honestly. For anyone unfamiliar, wrapping a token means converting it into a version that's compatible with a different blockchain or protocol. The most common example is wrapping ETH into WETH, wrapped Ether, so you can use it in DeFi protocols on Ethereum that require an ERC20 token format. Same underlying value, different technical wrapper. So is wrapping a taxable event in Australia? The case that it is a CGT event, the ATO has said clearly that crypto-to-crypto swaps are disposals. When you wrap ETH into WETH, you are technically exchanging one token for another. They are different assets with different contract addresses. Under a strict reading of the CGT rules, that's a disposal of ETH and an acquisition of WETH. Most Australian tax professionals currently apply this interpretation because it's the most conservative and defensible position if you're ever audited. The case that it isn't a CGT event, the counter-argument is that wrapping is economically equivalent to depositing cash into a different account. The underlying value and ownership haven't changed, only the technical format has. Some tax professionals argue that the substance of the transaction should override the form, and that wrapping should be treated as a continuation of the same asset rather than a disposal. There's also a reasonable argument that the ATO's guidance was written before wrapping was widespread, and that applying it strictly to wrapping produces an unintended result. Where does that leave you? The ATO has not issued specific guidance on wrapping as of 2026. That means there's no definitive answer yet. The conservative approach, treating it as a CGT event, is what most registered tax agents in Australia are currently recommending because it's the defensible position. But this is genuinely an area where professional advice matters, especially if you've done a lot of wrapping and the difference is material to your tax bill. My suggestion, record every wrap transaction regardless of which position you take. If the ATO does issue guidance, you want the data to either support your position or amend it. Alright, liquidity pools. This is the most complex topic in today's video, so I'm going to break it down into the key events: depositing, receiving LP tokens, earning fees, and withdrawing. When you deposit crypto into a liquidity pool, say you're adding ETH and USDC to a Uniswap pool, the ATO's likely view is that this constitutes a disposal of those assets. You're giving up your ETH and USDC and receiving LP tokens in return. That's a CGT event on the ETH and USDC at the time of deposit. This is the position most Australian tax professionals take, and it's consistent with how the ATO treats other crypto-to-crypto swaps. When you deposit, you receive LP tokens that represent your share of the pool. These are new CGT assets with a cost base equal to the AUD value of the assets you deposited. When your liquidity position earns trading fees, these are generally treated as ordinary income at the time you receive them, not capital gains. They get added to your taxable income for the year. The AUD value at the time of receipt is what matters. Here's one that confuses a lot of people. Impermanent loss, where the ratio of your pooled assets shifts due to price changes, is not a separately deductible loss under Australian tax law. The gain or loss is only crystallized when you actually withdraw from the pool and dispose of your LP tokens. At that point, you compare what you receive to the cost base of your LP tokens, and that's where your capital gain or loss is calculated. When you withdraw, you're disposing of your LP tokens and receiving crypto back. That's a CGT event on the LP tokens. Your proceeds are the AUD value of what you received. Your cost base is what you paid to acquire the LP tokens, i.e. the value of assets deposited. So in summary, a typical liquidity pool round trip involves two CGT events, one on deposit and one on withdrawal, plus income recognition on any fees earned along the way. Similar to wrapping, there's a debate about whether depositing into a pool is truly a disposal or whether it's more like putting assets into a managed account where you retain beneficial ownership. Some professionals argue the latter, particularly for single-sided liquidity positions. But again, the conservative and currently prevailing view in Australia is that it's a disposal. If this is material to your situation, get specific advice. Record keeping for LPs. This is where a tool like Coinly becomes genuinely important. Tracking the AUD value of assets at deposit, the LP tokens received, fees earned over time, and the value at withdrawal, manually, is extremely difficult. Most major DeFi protocols are supported by crypto tax software, which can pull this data automatically. Let's quickly recap before we close out. NFTs, clear CGT assets. Buying with crypto triggers two events. Selling, trading, and gifting are all disposals. Minting triggers CGT at the point of sale, not creation. The 12-month discount applies. Wrapping tokens. Gray area. No specific ATO guidance yet. The conservative position is that it's a CGT event. A reasonable counter-argument exists. Record every wrap regardless. Liquidity pools. Depositing is likely a CGT event. LP tokens are new CGT assets. Fees are ordinary income. Impermanent loss isn't separately deductible. Withdrawal triggers a second CGT event. Complex but manageable with the right tools. DeFi tax in Australia is genuinely one of the most complex areas you'll encounter. And the honest truth is, the law hasn't fully caught up with how quickly this space moves. The ATO is paying attention though, and the expectation is that you're keeping records and reporting correctly even where the rules aren't crystal clear. The best thing you can do right now is three things. Keep detailed records of every transaction, use a crypto tax tool to help you process the volume, and talk to a registered tax agent who actually understands DeFi if your situation is complex. If you want to see how I pulled all my own DeFi transactions together in Coinly, I've got a full walkthrough video linked on screen now. Check that out next. Drop any questions in the comments below, especially if you've got a specific DeFi scenario you're unsure about. I read every comment and it helps me plan future videos. Subscribe if you haven't already, hit the like button if this was useful, and I'll see you in the next one.